On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Morning all, hope you're well. That's another week down, and it was another good one for the US market at least. The S&P 500 was up 1% last week. That's the fourth week in a row that it's posted gains. And the S&P 500 is up 8.7% in November. So it's been a very strong month, the strongest that we've seen, in fact, since July 2022. So best month in a while. European shares rallied another 1.9%, so Europe continues to rise as well. The UK and Australia both slipped slightly, but only 0.2%, so not a lot in it. And the local market, the NZX 50, added 0.33%, 0.3%. So that's our fourth consecutive weekly gain. And our index is up 4.2% this month. So not quite as strong as what we've seen in the US, but still on track for the best performance since January. Looking at interest rates, the US 10-year Treasury yield was little changed, finished the week just shy of 4.5%, so still well down from I think it was a 16-year high, wasn't it, last month when it pushed above 5%. We're still about 0.5% off those levels, so it's sort of gone sideways. The local market, in terms of interest rates, the domestic 5-year swap rate increased slightly, increased from 4.65 to 4.82, so up a little bit. The NZX investment grade corporate bond index, which is a good proxy for fixed income returns in New Zealand, that index is up 4.7% so far this year. So that would see it does see it on track for its first calendar year increase since 2020. That index was down in 2021 and down again in 2022, and at the moment we're up. So that is obviously good news. Looking back at the key events from last week, we'll start here in New Zealand because I suppose the notable thing was that we got a government. So that's good. Election feels like it was some time ago, but now we actually have a government. We know what it looks like, and we have a fair idea what the policies that have survived will look like. So that allows economists and strategists and analysts to put all of those things into their numbers and have a bit of clarity about how policy changes will impact on the outlook heading into next year and beyond. So I guess where are we at? Tax cuts, they will become effective from 1 July next year. So that's National's tax cuts. They managed to get those through, which they'll be very happy about. That was a flagship policy. However, they won't be funded by taxing foreign buyers of expensive residential property. That was going to be part of the way the tax cuts are paid for, and that won't be the case. One would think that was New Zealand First's influence because they were one of the parties that put those foreign buyer restrictions on. So they would have campaigned, one would think, to leave them be. So they'll have to find another way to pay for it. And one would think that will be further spending cuts or expenditure savings. We don't know exactly what those will look like, but National has said that they did sort of bake in some leniency or some flexibility into their numbers. So we'll watch and wait and see, but the tax cuts are coming. Housing friendly policies, all of those things that National intended to do. The other two parties that are part of the coalition largely are in favour as well. So what you'll see is interest deductibility for mortgage interest on housing investments will be back. So investors will like that. It will reduce the cost burden and make housing stack up more than it does at the moment. from an investment perspective. We'll also see the bright line test relaxed a little bit, so investors will like that too. So I think the takeaway there is you've got a friendlier outlook from a policy perspective for the housing market. So while I don't believe that we'll see house prices rocket ahead, I do think it will support the housing market, and it will mean that the gains we've seen over the last 4 or 5 months will probably continue in a sort of modest way. The Reserve Bank changes there as well. So the Reserve Bank Act of 2021 will be amended, and they will remove the dual mandate. So at the moment, there's a focus on inflation, price stability, but there's also a focus on maximum sustainable employment. So they'll take that second thing away, and we'll just be back to inflation, which is what it used to be in the old days. And the purists out there will like this. So you'll get that change. They might also look at returning the Reserve Bank to a single decision maker model instead of having a committee, and they might also replace the medium term sort of target they have with something a bit more specific in terms of when they're looking at inflation and thinking about when it needs to come back to target medium term. No one really knows what that means, so they might put some specifics around that. I don't think those changes will really make much difference at all. Returning the mandate to that single one of price stability, I don't actually think their behaviour would have changed much at all if they'd had this single mandate in recent times. I'd be very surprised if there's a central bank anywhere, regardless of what's in their mandate, that is ignoring things like growth and employment and the labour market and so forth. They obviously look at all of these things, and they want a stable economy and a healthy labour market and so forth, even though inflation is the thing that they're specifically focusing on. So all of that's good stuff, but don't expect any major change. What else? Cabinet ministers to be sworn in on Monday, and then the new parliament will sit, I think, on the 5th of December. So that's in a couple of weeks. So I guess for now, the next thing to look forward to will be the mini budget, which they've foreshadowed, and the incoming Minister of Finance has indicated that we'll see this published alongside the regular haifu, which is due out in December anyway. They've got to do this before the House adjourns for the year, and I think that's a few days before Christmas. So the half-year update, that's due anyway, so we'll get that. So we'll get the usual half-year economic and fiscal update, the haifu. And one would think that will have some estimates from the Treasury around the impact of some of these policy changes, such as tax, such as spending cuts. So you'll see those factored into the Treasury's numbers, one would think. But we might also get the mini budget, which might tell us a bit more as well. So that's all good. That's where we're at on the political front. Good to have that locked in and sorted, and I think markets will be comforted by the certainty that we actually know what's going on now. Markets like certainty. They don't like being left to wonder what may or may not happen. So that's a positive that it's all done and dusted. The only other thing that really came out of last week in New Zealand, we had a dairy auction, a little softer than some had expected. The headline index slipped 0.1%, so that's the second decline in a row after that strong rebound that we had between mid-August and mid-October. But the falls have been very modest, so not a lot there. We also had retail sales; they were a little better than expected. So that's how the local week played out last week. Offshore, the key thing I was watching were the flash PMIs. So these are activity indicators, and they were for November. So it's one of the first economic releases we've seen for the month of November. Bit of a mixed bag. Most economies remained pretty subdued. Although there were some signs of stability in places. The US still stronger than just about everybody else. The composite PMI unchanged at 50.7. So 50 is your break-even point. You want to be above 50, that means there's an expansion taking place on a month-on-month basis. If you're below 50, you're seeing a contraction relative to the previous month. So the US 50.7, that's the 10th month. We've been in expansion over there, so that's good. But there were still some signs of a slowing economy. Firms reduced workforce numbers for the first time since the middle of 2020, and service providers joined producers, goods producers, in doing that and reducing headcounts. It's been goods producers that have been lowering workforce numbers up till now. Service providers have still been growing, but now you've got the services sector that is also seeing those headcount reductions. Cost pressures also continue to soften, so that's good news. And you'd expect that with a slowdown in parts of the economy, you would expect input prices to be rising at a slower pace, and they are slowest pace in over 3 years, in fact. So good news on that front, because that sort of all points to something that looks like a soft landing. The Aussie PMI fell to 46.4. That's the lowest in the history of the survey. Survey's only been going for 8 years, but that's the lowest outside of lockdowns. It was lower than that, obviously, during the lockdowns, but apart from that, it's the lowest we've seen since that survey came into existence 8 years ago. Even though that's really weak, it still probably points to a soft landing rather than a hard landing. We haven't seen any signs of anything more significant in terms of the decline. So again, that's a so far so good type of story. The European measure was up, still below 50, but it was better. So we saw some improvement there. Although Europe does increasingly look like it's headed for another quarter of contraction. So technical recession. The two consecutive quarters of contraction look like that is what we're about to see in Europe. So we'll keep monitoring that situation. The UK economy actually rebounded slightly in November. So the composite PMI there rose to above 50 for the first time since back in July. So I would guess that is due to the pause in interest rates and the slowdown that we've seen in inflation. Those two things seem to be supporting activity. And Japan was bang on 50, so stall speed pretty much, which is the lowest since December last year. And I think that is probably on the back of rising inflation pressures. Japan is seeing rising inflation in contrast to everyone else who's had their high inflation, and it's now starting to come down. So they are sort of the odd one out, and that's why they're probably the one central bank that still has more work to do, with just about everyone else in a position of being able to sit tight and probably not do anything more until the time is right to cut interest rates. Which brings me to the coming week, and we'll start here in New Zealand because that is where there's plenty of action this week. And the key event will be Wednesday's OCR decision and monetary policy statement from the Reserve Bank of New Zealand. So this will be out at 2 o'clock on Wednesday, and that will be followed by a press conference. So the OCR, the official cash rate, was last increased in May. It was increased to 5.5%, and it's sat there in the 3 meetings since then. So it's the highest since 2008, and it's looking increasingly likely that that is the peak. A few economists out there still see another hike from here, but a bigger group sees this as the peak, and I am part of that bigger group in terms of where my thinking is at. So I don't think you'll see any change in interest rates this week, which means it will all be about what we see in the MPS, the monetary policy statement, which will include a whole range of forecasts and projections for growth, for the housing market, for interest rates, for migration, for inflation, for sort of everything else. And I think what we will all be looking at is what have they done with their OCR track in that forecast pack. Because in August, which was the last time they did a set of projections, in August, that OCR track suggested some risk of further tightening, and it implied that the first OCR cut won't come until very late next year, or more likely early 2025. Now, some people think cuts will come sooner than that, and financial markets are pricing the first cut in, I think, sort of July or August next year. So that's when the markets see the most likely timing for the first cut to come. So Markets have moved their thinking since the last monetary policy statement, and we will be watching to see whether the RBNZ makes any effort to dissuade markets from that type of thinking, or whether it is comfortable with that type of thinking. My guess would be they will leave their sort of forecast largely unchanged in terms of that path of the OCR. I don't think there's any real benefit or advantage to the Reserve Bank by saying, look, you might get a cut sooner than you think. They might do that, but I think they probably will want to keep people's behaviour as constrained as possible, just to make sure that the job is done. So that'll be Wednesday afternoon. No change expected to the OCR, all about the forecasts. We'll also have the ANZ Business Outlook survey for November. This will be at 1 o'clock on Thursday. Be watching for any change in sentiment there across key sectors, any progress on the inflation front, signs of easing wage growth. It's been pretty good the last couple of surveys. Headline confidence has improved to the highest since 2017. Own activity, which is a much better and more useful leading indicator for where economic activity is going. So that's the one that I tend to watch most closely. It's also increased. It's not quite as high as the headline measure in terms of where it when it was last at these levels, but it's still at the highest levels since mid 2021. Inflation indicators have remained elevated lately, but they've been sort of coming down. So those are things we'll be keeping an eye on too. Internationally, the key releases that I will be watching will be the PCE inflation report out of the US, personal consumption expenditures. That is due on Thursday in the US, so it'll be overnight for us. We'll get it on Friday. But it's important because it's one of the Federal Reserve's preferred inflation measures. The Fed believes this inflation measure is better than the regular CPI. So if that's what the Fed's watching, that's the one that we've got to watch. And it'll be the last release of this nature ahead of the upcoming Fed meeting, which is in mid-December. So I think a matter of hours before that Fed meeting, you'll get the regular CPI, the regular inflation report for the month of November, but the PCE inflation report won't come until after that Fed meeting. So this is the last one. It'll be for the month of October. You would think that it will look similar to the regular CPI, which we've already seen for the same period. Now that had further evidence of cooling price pressures. So markets are expecting the headline PCE inflation rate to slow to 3.1% annually, which would be well down from the peak. The peak was 7.1 last year, and 3.1, that'd be the lowest since March 2021. The core PCE forecast to have increased by 3.5%, which would be down from what we saw in September. It was 3.7%, so down from 3.7 to 3.5, and that will be the lowest since April 2021. The forecasts in the Fed's most recent forecast pack suggests that the core PCE will slow to 3.7 by the end of this year, and it's already at 3.7. Now it's expected to come down to 3.5. So if those numbers come in as expected, it would say that the Fed is more on track than it expected to be, which would obviously be good news. Like the Reserve Bank of New Zealand, the Federal Reserve is seen as being at the top of its hiking cycle. Their Fed funds rate is at 5.5%, and they've got one more meeting, as I just said before, in December, so no change expected. And then it's really a case of when do we see the first cuts. Markets think we might see the first cut, June-ish next year, May or June, is where the pricing indicators have oscillated between in recent days. So markets starting to get quite excited about OCR cuts and Fed funds rate cuts and so forth. Maybe too excited. We'll wait and see. The ISM manufacturing index is also out in the US next week, so this will be the other key release. It'll be out on Friday. In October, it was much weaker than expected. That fell much more than people were expecting it to. So we'll be watching this report, as it's a good indicator for how the manufacturing sector is tracking. And there is a services measure as well that goes along with
with this, the ISM Services Index, but we won't get that this week. It will follow next week on Monday or Tuesday, I think. Chinese economic indicators will be in the spotlight. We've got the Chinese PMIs, so these come a little later than those flash PMIs that I talked about at the start, or earlier on at least, but they tell you something similar in terms of just measuring economic activity on a month-on-month basis. We'll get the official PMIs, which are the government ones, at 2:30 on Thursday, and then you'll get a private sector one on Friday afternoon. So you sort of put those together and use your own judgments about whether they really tell you anything. My guess would be that they'll look reasonably subdued. Most things have in China. We got some monthly indicators just in the last couple of weeks, and they actually looked okay, but the property sector very much still a drag, and some of the good numbers only looked good because the period we were comparing them to a year ago was quite weak. So they were a little bit misleading, to be honest. So those are the key economic releases that we've got coming up. We also do have a couple of central bank speakers. Fed Chair Jerome Powell will speak on Friday. Earlier in the week, we've got speaking engagements from the ECB president, the European Central Bank president, Christine Lagarde, and the Bank of England governor, Andrew Bailey. They're also scheduled to appear at various times. Across the Tasman, a couple of things going on across the Tasman, the most important of which will be the CPI indicator for October, the Consumer Price Index indicator. And this is the monthly inflation indicator, which is important in the context of what the Reserve Bank of Australia may or may not do. They've got a meeting next week. That'll be their last one of the year. And they're expected to be on hold, just like the Reserve Bank this week, just like the Federal Reserve in mid-December. But the Aussie Reserve Bank is probably the one out of those three where if you were going to get a surprise rate hike, that's where it would come from. And so this inflation report that we'll see across the Tasman will be of some relevance to that. Quite a bit happening on the corporate earnings front, not so much offshore. The only one I've got on my list is Salesforce, but locally there are quite a few companies set to announce results: Kiwi Property, Radius Health, Arvida, Gentrack, Argosy, E-Road, Fish and Paykel Healthcare, Metro Glass, Ryman Healthcare, Trade Window. So there's a few. The two big ones are obviously Fish and Paykel Healthcare and Ryman. Both of these will be first half results for the 2024 financial year. Those two companies have financial year end of 31 March. So this is the first half of the 2024 financial year. Both of those are out on Wednesday, and both of them have been in the spotlight for various reasons. FPH, Fish and Paykel Healthcare, down slightly this year, so it's kind of moved in line with the market. Ryman's up slightly this year, so it's actually been a better performer than most stocks on the local market. But remember that Ryman took a beating last year, was down more than 50%. So you would expect it to be rebounding a little bit more than most. But they're both heavyweights. They're both widely owned. They're both widely followed, and they've got similar but different challenges that they're facing. For FPH, it's been the weight loss drugs, which has made people question the company's growth prospects, because obviously if people are healthier and able to lose weight more easily, there will be potentially less demand for Fish and Paykel Healthcare's products, or some of their products at least. So that's in question. We'll be watching what they say about that and whether they have any thoughts on how it may or may not impact them. Ryman is obviously still trying to rebuild credibility after the issues that they have faced over the last couple of years. Something in their favour, I think, is that the housing market is rebounding, and I think with those policy changes you're seeing from our new government, that will continue. So we'll be watching those things. That's probably all we've got. Not a whole lot across the Tasman in terms of corporate news. Collins Foods got a result. AGMs from Ramsay Healthcare and Harvey Norman. So those will be interesting as always. But just checking my notes to see if there's anything I've forgotten. No, I think that's it. So Enjoy your week, team. Hope you have a good one, and we will talk again soon.